Hello friends, last week in my video, I explained to you whether the banking problems in the United States could cast a shadow on Indian banking stocks. I told you that Indian banking stocks were uniquely poised and our banking issues were different from the United States. I explained to you about retail unsecured lending that is being resorted to by banks, and sure enough, the RBI Deputy Governor, Mr. Rao, has issued a statement in the media highlighting the concerns that we have. And he's also talked about evergreening of loans. What is evergreening of loans? You can please connect with us on our free Telegram channel where I've answered this query in great detail. Now, coming back to the issue at hand. This video's thumbnail is about who the market is likely to support. Is it Hassan Nasrallah, the Secretary General of Hamas? Or is it Benjamin Bibi Netanyahu, the Prime Minister of Israel? Well, I have updated Hassan Nasrallah's speech in real time on Friday evening, late Friday evening on our free Telegram channel. Please make the effort of connecting with me there and going through his speech. In brief, let me tell you what I gathered from what Hassan Nasrallah said. He was basically talking tough, which is but natural, about Israel learning a very bitter lesson. That is something that Hezbollah is bound to say. But he was increasingly talking about getting support from the Arabs, which was not forthcoming. He was not happy with the way the Israelis were not boycotted by the Arabs for oil and gas sales. He wanted more proactive support, both moral support and as well as material, food and medical support from the Arab nations, which tells me that this was a far more softer, relatively speaking, of course, Hassan Nasrallah, who was speaking yesterday. And he spoke for well over 100 minutes. And I don't think that this speech hinted anything about an all-out war coming in the absolute near future. If there are new developments, we can't say. War is unpredictable, but who is the market supporting? Now, I have a few data points to share with you. On your screen right now is a daily chart of WTI crude oil. See how it is broken below a rising trend line. Number one, it's trading below its 20-day exponential moving average, which is a month-long holding on cost of an average bull. Number two. Number three, what you are seeing is no panic from the oil market. Now, getting signals, getting indications from asset classes is called the weight of evidence approach. Those of my online family who've been connected with me long enough know that I practice what is known as a 360-degree approach to financial markets based on behavioral analysis, behavioral finance. Now, if at all there was large-scale nervousness in the market, why are oil prices not rising? Why are gas prices not going through the roof? This is the market's way of saying, hey, we are putting our money on a war that is going to be localized. It's not spreading, at least for now. And the way Hassan Nasrallah was talking about Iran not knowing about this attack beforehand, Hezbollah not knowing about the attack beforehand, it was his way of saying, look, we didn't plan it, we didn't plot it, therefore don't come and blame us for it. I don't think he's itching for a war. So who does the market really bet its money on? I think the weight of evidence is indicating that the market is betting on Israel having an upper hand in the war and possibly the war remaining localized, and see the ceasefire probabilities are something that the market is banking on. Friends, now that we've tackled the issue of who the market is really betting its money on, let's proceed to our usual statistical analysis of the market And what you are seeing on your screen right now is the week on week market roundup, which tells you that it was the banking sector which kind of led the way forward by rising more. The Bank Nifty rose more than the Nifty 50 due to a relief rally. Number one, you had the US Federal Reserve, which did not raise rates. Number two, you had the Bank of England, which kept the rates steady and unchanged, and therefore there was short covering in the banking space. The US dollar index, the Dixie, fell 151 basis points, and that also triggered a relief rally in emerging markets, including India. Silver went up due to a weak dollar, but gold witnessed some profit taking because the war was not seemed or expected to last too long after Hassan Nasrallah's speech, especially. Now, the USD INR rose 5 basis points. That tells you that the rupee continued to weaken against the dollar. The Indian 10-year benchmark bond yield fell 3 basis points. That means bond prices went up. And that was another reason why the banking stocks were slightly more bullish as compared to the Nifty 50. The NSE gained 1.5% in market capitalization, which tells me that the up move was fairly broad based. And the MWPL, or market wide position limits, rose 5.5% on a week on week basis, which is routine because after expiry, traders do tend to increase their exposure. The US headline indices rose very smartly, each one of them rallying more than 5%, and that provided tailwinds to our markets also. Friends, I now come to our in-house indicators, starting with the market-wide position limits, or MWPL. Now, this is the exposure utilized by traders as compared to the exposure allowed by SEBI. What you are seeing is a regular dip every 4 weeks, that is expiry, and then a rally for 3 weeks thereafter. So in the first full week after expiry, in the October series expiry and the November futures, which are playing out right now, you are at 33.43%, which is definitely lower than the prior 3 months, and therefore traders are showing signs of caution. I don't blame them. There is a war in Gaza, plus the market prices are a little heavy still, and therefore traders were seen marginally cautious. Let's now take a look at the stock and index futures turnover. These are 3 concurrent series, so it is November, December, and Jan. Now here again, there is a spike every 4 weeks, that is due to expiry, and post expiry turnover does tend to fall. So there was a routine fall post expiry, and the fall is not as bad as you had seen approximately 4 to 5 weeks ago. So we need to see how bulls and bears take it forward from here. Friends, the next one in line is the advanced decline ratio. This is the average of all 5 trading sessions during the week. The Nifty has gained 0.96% on a week on week basis, and the advanced decline ratio has risen marginally to 1.38. Over the prior weeks, 1.29, which means for every 100 shares falling during the week, there were 138 shares rising. Bulls continued to have an upper hand in the market. Now I come to the basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. It is a good proxy for risk appetite. The higher the basis, the more premium bulls and bears are willing to accept in the market. But like options premium, basis also tends to contract as expiry approaches. And sure enough, you saw both the Bank Nifty and Nifty basis come down. This is something I had told you last week in my video, that such lofty levels of basis were unlikely to last. And sure enough, they are coming down. They are expected to come down this week as well. Does it mean that risk appetite is falling sharply? Not falling sharply, but I would say there is some amount of sanity. Now for the next in-house exclusive indicator that you've trusted for over 2 years now, the impetus. which measures the force in any price move. Now, what is worrying me slightly is the fact that both the indices have recorded a very sharp decline in the impetus, both the Nifty and the Bank Nifty. Both the indices clocked gains, but the impetus has fallen, which means it was more of short covering that had lifted the markets up rather than very aggressive buying. Buying may have taken place, I'm not denying that, but it was not aggressive. Had it been forceful and aggressive, impetus readings would have gone up. So, ideally, if the bull market is to sustain, both the prices and the impetus readings should have gone up, but they are not. So, this is something that I update on a daily basis on our social media accounts. Do take the trouble of connecting with me on any of the handles. My contact coordinates come at the fag end of this video. Friends, now for the next exclusive in-house indicator, the LWTD, which you've trusted for 1.5 years or more, and you've given me a lot of positive feedback. I thank you for that. Last week, I told you that the LWTD had jumped sharply and therefore I expected markets to experience support on declines. And sure enough, the LWTD stood the test of time, surprised traders by being right yet again. Now, the LWTD has come down to 0.13 as compared to prior week's 0.44. This in spite of the fact that Nifty has clocked gains after remaining negative for 2 weeks in a row. What does that tell you? It tells me that on advances, on rallies, I should expect, relatively speaking, mildly lower fresh buying support. Remember, I'm talking of fresh buying support, not short covering. They are two separate things. Short covering will cushion declines. Fresh buying will take the markets to new highs. So, the buying support may be a little tepid. Can it change? Yes. You should watch LWTD on a day-to-day basis. Where do you get this? On my social media accounts. Friends, our in-house indicators done. I now come to the bond market, which I have been telling you since many years that it is actually the source of all money supply, the fountain of all money supply for all asset classes, which is why you should cover it first. Now, the Indian benchmark, 10-year benchmark bond yields came down 3 basis points. The RBI successfully conducted sales of 50-year bonds and there was good reception to the long tenure bonds. This is the first time that 50-year bonds have been offered and lapped up by insurance companies and banks. The open market operations also are continuing, which is why the bond markets seem to be fairly chilled out and not getting too nervous about it. What am I doing? Sitting on the fence. Why? Because neither are yields falling below 7.05 or 7%, nor are yields going above 7.5 or 7.6. Above 7.6, ladder again. Below 7.05, go for gilt funds. When could we do that? You will get all these updates on our free Telegram channel without fail. Remain assured. Do take the trouble of connecting with me there. Friends, the bond market's done. I now come to the Bank Nifty, which took charge, led the way on the upside and rallied more than the Nifty 50. What you are seeing on the daily chart on your screen is that the Bank Nifty rose on 3 out of 5 trading sessions. Pay particular attention to the last 3 candles on the daily chart of the Bank Nifty. You will know why the impetus reading has come down. What you are seeing are dojis, where the open and close is almost the same. But because of a gap up, you are seeing gains being notched on the index, which is why the impetus reading was down, because it was a gap up open. It was not a buy during the day which pulled the index higher. That's all right. As long as the index is gaining, if there's follow-up buying support coming in, all is forgiven. But follow-up support is extremely important. The head and shoulder pattern that I have marked on the screen with a blue color neckline, the price has closed and remained below that neckline, as also below its month-long moving average, which itself is headed lower. Do remember, since the last few weeks, I have been sharing a study with you as to which index is getting you better results. Look at the chart on the inset box on your screen. The Bank Nifty has been underperforming the Nifty 50 over 4, 12, and 20 week time frames. So it's not really surprising that you're seeing the Bank Nifty index on the daily compression period being below the short term thresholds of head and shoulder neckline, as well as the 1 month long moving average. Coming to the weekly chart on your screen, it shows that the price is below its 25-week exponential moving average, which is a 6 month long holding on cost of an average bull. So the medium term outlook remains cautious. I have marked a wedge formation with two red trend lines. The price, although has jumped last week, has still remained below the wedge formation's lower trend line. There's a very weak and unconvincing bullish piercing pattern because the bullish candle has pierced the body of the prior bearish candle, but I wish the bullish candle size was a little bigger, which means more follow-up buying is needed to convince the bears to cover their shorts. The previous swing high of 41,840 will act as a near-term support in the coming weeks, which needs to be noted. And like I told you, the Bank Nifty still underperforms the Nifty 50 over 4, 12, and 20 week. Friends, in the week before last, this index was at number 3 on our most volatile counters list based on statistical beta that we maintain in-house. It rose one notch to go to number 2. Now, the Bank Nifty is the second most volatile counter in the F&O space. Not a good sign, because the more volatile a counter is, the more difficult it is for an average retail trader to make money out of it. Volatility can cut both ways. So if you're right, it'll give you a lot of money. If you're wrong, it'll take away a lot of money. And retail guys invariably tend to get trapped in false moves. So be careful out there. Last week, I advocated an estimated range between 44,425 on the upside and 41,150 on the downside, which held perfectly well. In the coming week, I estimate a range between 44,450 on the upside and 42,200 on the downside. Friends, please also refer to the free daily, weekly, and monthly pivot levels which we update on our free Telegram channel. This will help you as an intraday, a swing trader, as well as an options trader, both as an option buyer and as an option writer, by giving you fairly accurate support and resistance levels. So do take advantage of this free feature. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 0.96% on a week-on-week basis. Just like the Bank Nifty before it, it also rose on 3 out of 5 trading sessions. And the 18,887 level has acted as a support, a fairly reliable support since July 2023, and that needs watching. The 19,224 bullish, a flag formation low, which I have marked on the chart at 19,224. The Nifty has closed above that mark, but in order to convince the bulls that, in order to convince the retail trader that bulls are back in action, bulls need to take the Nifty 50 consistently above the 19,600 mark. The price is below its month-long moving average, which is itself trending lower. So this is a pullback rally as of now. I'm not saying that the Nifty cannot rally from here, but what it will need is ample amount of follow-up buying support. Coming to the weekly chart on the screen, unlike the Bank Nifty, the Nifty has no bullish piercing pattern because the bullish candle is way too small to satisfy the piercing candle criteria of 50% of the body being pierced. The price is mildly above its 25-week exponential moving average, which means the medium-term outlook is cautious, but compared to the Bank Nifty, the Nifty appears to be on slightly firmer footing. The Nifty continues to provide better returns over 4, 12, and 20 weeks in relative comparison with the Bank Nifty, and therefore the strength in the Nifty is where you should be betting on, at least for now. Friends, in the week before last, this index was at number 7 on the most volatile counters list based on statistical beta rankings we maintain in-house. It fell 2 notches to number 9. It's not that the volatility of the Nifty fell. It's also that the volatility of individual counters rose faster than the Nifty, which has resulted in the Nifty ranking dropping a little bit. Last week, I advocated an estimated range between 19,650 on the upside and 18,425 on the downside, which held perfectly well. In the coming week, I expect an estimated range between 19,625 on the upside and 18,850 on the downside. If at all any positive news emerges out of the Gaza war front, I expect a short covering rally, and therefore you should be prepared for surprises along the way. Volatility is likely to be high. Please also refer to our daily, weekly, and monthly pivot levels that I update on our free Telegram channel to help you as intraday swing and options trader. Friends, I come to the last bit of statistical analysis wherein I share the risk appetite of retail traders based on the footprint of the turnover contribution that they have in the 4 segments of the FNO. On your screen right now is the chart of a 20-week time frame. What you are seeing is index futures turnover fell 4 basis points, indicated as a blue line. Not a surprise there. Do remember, every 4 weeks the turnover spikes, that is expiry, and just like the turnover of the prompt month futures that we saw before, here again a futures turnover will come down. The stock futures turnover also fell by 30 basis points, indicated as a red line. Index options, indicated as army green line, went up. As a matter of fact, it was the only segment that was gaining through the week. And this happens to be the lowest volatility and the lowest capital requirement instrument in the derivative space out of the 4 segments. Stock options saw turnover decline by 17 basis points, which is indicated as a purple or violet line. So where the turnover went up was in the least volatile, least risky instrument. So definitely bulls were a little cautious. Friends, I now come to the segment where I share my strategy. I remain bearish on oil. I've put up a lot of data, a lot of my thoughts, a lot of research that has gone into why I recommend or advocate a direction on any asset class. On our free Telegram channel, I've shared all that. Please refer to it. It's a one-stop shop. It has the most amount of our research out of all our social media accounts. Gas is rising due to winter cyclical reasons, which is routine, but do refer to the DCA analysis, which seems to indicate that bulls are now a little circumspect. They are not half as gung-ho as they were at last year at this time of the year. And MWPL in equities is rising rapidly, which tells me that short covering may basically be seen as soon as some positive news comes from the war front. Beaten down counters in public sector units and public sector banks may also see some short covering if at all there is a positive announcement on the war front. If oil prices continue to fall the way are falling, oil marketing company stocks may gain. Theta decay in the options segment in energy commodities, that is crude oil and natural gas, continues to remain a good choice of strategy. Bullion is holding ground as of now due to Diwali as well as central bank buying. Metals in the commodity markets are showing relative firmness due to some amount of fresh buying. thanks to the sigh of relief that the war may end. That is what the market expects. And therefore, metal stocks might either fall less or might even see some short covering in the equity markets. Now, 7th of November onwards, you're likely to have elections in Mizoram and Chhattisgarh. So, there might be a little bit of edge of the seat excitement in the market, and therefore, there might be a little bit of bigger swings in prices, A, due to the war, B, due to the flagging off of the state elections. I think traders are a little more relaxed, or rather a lot more relaxed as compared to the prior week where news on the war front is concerned. So I think they are going to see a bigger risk appetite in the week ahead. Do trade with stop losses, do have your exit points ready beforehand, and let's play a very controlled and calculated game. Friends, before I sign off from this video, a reminder to subscribe to our YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment segment, do let me know what you think of our work and how it helps you become a better trader. Also, help me reach out to a bigger audience by sharing my video with like-minded smart traders like yourselves. Thank you for your patience and being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Wish you have a very profitable week ahead. Take care. Bye-bye.